Continuing our ratio analysis in Chapter 16, the next set of ratios is looking at debt management. So how well is a corporation utilizing debt, and how much debt are they taking out? So we look at times interest earned ratio. This is the most common measure that banks use to look at a company's ability to pay for long-term debt. Any ratio less than 1 is inadequate to make sure that we can cover debt. So our earnings before interest, expense, and income taxes, that's also called EBIT, or earnings before interest and taxes, divided by our interest expense, gives us the times interest earned ratio. Our next ratio is the debt to equity ratio. This shows us how much debt we have as compared to the amount of equity that we have out. Of course, if we're looking to finance something or borrow money, the bank that's going to be loaning us money prefers that we have less debt and more equity. Stockholders prefer debt if the company's rate of return on its assets exceeds the rate of return paid to creditors. As I said in the last video, there is a formula to calculate what a good debt to equity ratio is for an organization, and we look at that more in business finance when we do financial calculations. So the debt to equity ratio is calculated by dividing total liabilities by total stockholders' equity. This is the equity multiplier. So this ratio indicates the portion of a company's assets that are funded by equity. So equity, remember, is retained earnings and the stock that we have sold. We take average total assets and divide by average stockholders' equity to get the equity multiplier. Our next set of ratios are the profitability ratios. So how profitable are we? First, the gross margin. So the gross margin indicates how much of each sales dollar is left after removing cost of goods sold. Not all companies have cost of goods sold. This is most common in companies that have inventory that they're selling. Although service companies will have a cost of sales or cost of completing their service. So this is the gross margin divided by sales. Net profit margin looks at net income. So net income divided by sales. So how much money do we have left over from our sales after we pay all of our expenses, including interest and tax expenses? Our return on total assets. This is net income plus interest expense times 1 minus the tax rate divided by average total assets. So we add interest expense back to net income to show how the return on assets looks, comparing the amount of debt or over time for a single company that's changed this amount of debt and equity. So that's one of the reasons that we add the interest expense back, but we also want to make sure that we adjust that interest expense for taxes. Return on equity. This is how well we use the owner's investments to earn income. So we looked at return on assets, which is how well we use our assets to generate income. And this is how well we use equity to generate income. So this is net income divided by average stockholders' equity. Our return on equity can also be computed using the DuPont formula shown here, which is net profit margin times the total asset turnover times the equity multiplier. Financial leverage. This is the difference between the rate of return the company earns on investments in its own assets and the rate of return that the company must pay its creditors. So if our return on investment in assets is higher than the fixed rate of return on borrowed funds, then we have positive financial leverage. If it's less than, then we have negative financial leverage. Ratio analysis for market performance. So when we look at market performance, this requires us to sell stock in the marketplace. We need to know information about the market price per share, dividends per share, our stockholders' equity, and any shares of outstanding stock. Our earnings per share is net income divided by average number of common shares outstanding. The average for the year is used in the denominator, and earnings form the basis for dividend payments and future increases in the values of shares of stock. Many companies include the earnings per share calculation in their financial statements that they provide to the public, because it's not always easy to calculate what the average number of common shares outstanding is for very large publicly traded companies. So this is the average for an entire year. And as stock sales change from day to day, it can be difficult to tell. We can see here where we had 17,000 at the beginning of the year and 27,400 at the end of the year, that is what we would use to calculate our average for these calculations. So we take the net income divided by the average number of common shares outstanding, and it gives us earnings per share of $2.42. So how much of our net income was earned for each share of common stock outstanding? The price earnings ratio, or PE ratio, looks at the market price per share as compared to the earnings per share. The higher PE ratio means that investors are willing to pay a premium for our stock because we have optimistic future growth prospects. We take the market price per share divided by earnings per share to calculate the PE ratio, price earnings ratio. Dividend payout ratio is dividends per share divided by earnings per share. This ratio shows the portion of current earnings being paid out in dividends. Investors that are looking for companies that pay out a lot of dividends would want this ratio to be large and would be looking for companies that pay out a lot of dividends. Investors who are just looking for market price growth for future sale of stock would want this ratio to be small. And different companies have different payout of their ratios. Some companies don't pay dividends at all. Dividend yield ratio is dividends per share divided by the market price per share. This identifies the return in terms of cash dividends on the current market price of the stock. It can also be used to calculate what future growth of the stock will be based on what dividends are paid compared to the market price. And then the book value per share. So the book value per share is the amount of common stockholders' equity that is on the books compared to the number of common shares outstanding. So this is different than the market value of stock because the market price reflects expectations about our company's performance, any dividends paid, whereas the book value per share that we keep on our balance sheet is based on the cost they were sold for the very first time, that historic cost. So it's not a reflection of current market price. So to calculate the book value per share, we take common stockholders' equity and divide by the number of common shares outstanding. Now, note that this is not average number of common shares outstanding like the earnings per share or EPS calculation. And where do we get information about financial ratios? Well, we can find them online. We can look at the publicly provided information of companies that have to provide information. Any company traded on the stock exchange has to offer this information publicly. There are sites that compile this information for financial ratios. And then there are also websites that compile this information by industry in order for industries to be able to benchmark themselves against each other or looking at the industry standard. As I said earlier, difference in accounting methods between companies sometimes make comparisons difficult. For example, if a company is using completely different inventory valuation methods than a comparison company. Sometimes you also need to know historic information about the company in order to understand what might be happening to make their ratios change from one year to another. For example, I have Nike and Adidas companies information for 5 years in the final project. And it would be important to note that Adidas has done some acquisitions and sales of other brands that has had a big impact on their stock price, as you would see if you looked at their financial statement information. We also need to look at beyond just the ratios within our SEP into what is happening out in the world. Are there industry trends? Are there changes within the company itself? Like I said on the last slide, has the company made some kind of investment? Are they bringing out a new product line? Did they merge with another company? Maybe consumer tastes have changed. What are the economic factors? We'll see in the next 5 years, we're going to see some impacts on all industries from COVID-19. We're going to see financial impacts starting to show up in financial statements. You can already see that a little bit in Nike's financial statements because their year runs from June 1st to May 30th. Their most recent financial numbers show the very beginning months of COVID-19 from last year, where we're just starting to see financial information from other companies, from the kind of economic impact. And as that economic impact from COVID continues to disrupt inventory and shipping and other things, companies are going to continue to see changes from that impact in the future.